The Kiwi is taking a hit today after the release of the RBNZ's latest survey of expectations, and the reason is straightforward. Two-year inflation expectations fell sharply from 2.53% to 2.34%. The one-year ahead measure also declined to 2.6%, a big drop from what was seen 3 months ago. This survey asked professional forecasters, economists, and industry leaders their views on the inflation outlook. So it gives the RBNZ a steer on how people closely engaged with the economy see the risks evolving. That matters because the inflation expectations survey has historically had a strong influence on the RBNZ's interest rate decisions. At its last meeting in July, the RBNZ delivered an explicit tightening bias, saying that further cash rate increases appeared likely, but stressed the timing was highly uncertain. It also said that future decisions would depend partly on how price-setting behaviour affects medium-term inflation. So today's fall matters a lot. Before the release, markets are pricing close to a full 25 basis point hike at the September meeting. But the historical work we published earlier today suggests that may be too confident. Looking back across more than 2 decades of data, there have been 11 occasions where two-year inflation expectations have fallen to a range of 2.25 to 2.5%. The RBNZ hiked the cash rate at its following meeting just once. Now that doesn't mean the tightening cycle is over. Far from it. The RBNZ still has an explicit tightening bias, meaning it's entirely possible we'll see more. But with inflation expectations dropping sharply and history showing the bank has rarely hiked immediately from this part of the range, September looks far less a lock than what was the case earlier today. While the RBNZ is likely to hike again, just don't assume it will be in 2 weeks' time. Best of luck with your trading. I'll catch you next time.